China becomes the world's largest automotive exporter. Alibaba beats most analyst estimates in its latest earnings report, and retail sales over the past few months show some strength in the Chinese economy. But despite all this seemingly good news, the Chinese stock market and the Hang Seng index is about to wipe out all of its gains of 2023, with stocks like Alibaba, Tencent, JD, and Baidu nearing 52-week lows. With the American stock market in the Nasdaq and the S&P 500 performing relatively well so far this year, there is a lot of concern about exactly why the Chinese sector is lagging so much. Whether it be geopolitical, economic, or trade war-related issues, investors are clearly losing some confidence in the Chinese tech sector. So, is this drawdown in the Chinese stock market actually warranted? What could be causing it, and what is the outlook for 2023? Those questions are exactly what I want to address in this video. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So, to start things off, folks, if you want the simple answer to this question as to why China is underperforming, it has all to do with three things: geopolitics, the weakness of the yuan, and an uneven recovery. Essentially, what has happened over the past few months is that data in China, although coming out strong, is not beating the estimates of most foreign investors. Industrial production and retail sales came in around 30 to 50% below analyst estimates, and although these data numbers are an improvement from what has happened last year, they are simply below what estimates were. And that is the simple reason why Chinese stocks are underperforming those in the US. Now, as a long-term investor or somebody looking to participate in this recovery in the Hang Seng index, this should truly not be that big of a concern, because all this signals is that investors in the US and Europe misjudged how strongly the Chinese economy is actually recovering after COVID-0 was axed in December of last year. Just like any individual stock would miss a few earnings estimates here and there, companies in China will see different recoveries, and the index will perform differently compared to those in other countries. The fact of the matter is that the Chinese economy is extremely important to the global tech sector. Not only have they become a manufacturing and technology hub of the world, but now they're also exporting more cars than any country on earth, with a pure focus on the EV space. And not only that, but China's biggest e-commerce company, in some cases bigger than Amazon, also announced its new restructuring plan, which is allowing the company to be a lot more streamlined with its capital raising plans, allowing shares of Alibaba to jump more than 30% after the announcement. As a matter of fact, Alibaba's free cash flow margin jumped by more than 30% in the first quarter of 2023. This beat most forecasts from analysts, and their losses shrank across main businesses like Taobao, Taisaco, local consumer, and digital media. But despite this stellar performance, something like Alibaba, as you can see, is now trading at a forward PE of 8.36 and has mostly wiped out all the gains that it saw after that particular earnings report. And this performance is also being reflected in the broader Hang Seng index. But as I'm sure all of you know, short-term movement is not an indication of long-term performance. China, although has some headwinds in the short term from geopolitical to trade and to economic, there is still opportunity brewing for those that have the correct risk appetite. You see, first of all, the Hang Seng Index in China is trading at a price-to-earnings ratio of 6.74, which is by far the cheapest across all the major global indices. And that is with China on track to reach its 5% GDP growth target for 2023, which is far above something like the US, India, or even Germany. This means that the growth opportunity for domestic commerce in China is larger than most other indices, yet the index in China is trading cheaper than all those. And on top of that, another one of the recent headwinds that has plagued Chinese stocks, which is the Chinese yuan, is actually a signal of long-term strength in the economy. The reason that Chinese yuan is falling is mostly because investors are expecting interest rates in China to be cut sooner rather than later. And as we all know, the only reason a government cut interest rates is to spur economic growth, and that typically coincides with fiscal policy to spur investments. And as a matter of fact, analysts for 76 companies on the Hang Seng index have increased their earnings outlooks by around 12% for 2023. And with the way that the market is performing over the past couple of months, that is simply being completely discounted by most retail investors. And you can have a look at none other than India to understand the implications of a falling currency to the performance of the index. The Indian rupee to the USD has been performing very poorly for the past 24 months, but the Sensex flagship index for India has gone up more than 14% over the past 1 year. This clearly shows that there's very little correlation in the long term with how a currency performs to the flagship index of that country. And although the Chinese EV sector has seen some gloom over the past couple of months, with earnings not coming quite as much as investors have expected, rest be assured that February and the first quarter of the year is typically the weakest for the Chinese economy because of the New Year holiday. And because most investors in the markets are focused mostly on the short term, prices for Chinese indices have slumped. This has resulted in foreigners rushing to sell and resulting in price declines for the CSI 300 and the HSI index. In the long term, this can be an opportunity if you pick the right companies or if you stay patient enough, but in the short term, as we all know, markets can be irrational. It's pretty clear that the initial boost from the reopening is no longer driving Chinese stocks. Instead, now the focus is on how well and how quickly the Chinese economy can recover, as well as understanding the geopolitical risks with Taiwan and the US-China relations. The fact of the matter is that the Chinese consumer has recovered to pre-pandemic levels, meaning spending on a retail level is increasing at the fastest pace that it has ever before done over the past 36 months. This means there is growth opportunity for startups and conventional companies in China like Alibaba who are restructuring their business and focusing more on cost cutting. The service sector in China is performing very well, and fiscal policy and support from the government seems to be on its way. The only issue that markets are trying to price in the short term is an uneven road to recovery, with manufacturing and real estate lagging the way. Whether or not this problem fixes itself throughout 2023, only time will tell. But as usual, guys, let me know your thoughts on the situation down in the comments section below. Thank you very much for watching, and I'll catch you guys in the next one. Take care.